Good morning, everybody. Welcome to another episode of the Market Think Tank with Bob Iuorio. I am said Bob Iuorio. It is June 28th. Basically, we're at the end of the month, end of the quarter. Um, June ends, the second quarter ends. There is quite a bit to talk about as we look at U.S. forces bombing rebels, Iranian-backed rebels in Syria, likely to affect crude oil prices. We've got markets ready to open up at new highs. We're not sure if that'll actually happen. Futures are pointing in that direction. And I've got a self-proclaimed perma bull waiting here with me. I don't know if you'd actually call yourself that. You said you come across as one. Charlie
Yeah.
Moon's stock strategist at Prosper Trading. Tell me about your perma bull statement that you gave me in the notes before the show.
Yeah, I understand the concerns of, rising inflation. In fact, it's been a while since I've been on, but the last time we're on, we were talking about that. And this is really before the markets kind of started rolling over. And really, we saw a lot of the growth, plays and tech names roll over and, shed 30-40% off their highs. And here we are, NASDAQ making new all-time highs and S&P making new all-time highs. And we still have the inflationary concerns. We still have concerns. Now it's ramping up in the Middle East, and of course, we still have China. Right? China is trying to take over the dominance or take over the title of being the powerhouse of global economy. Right? We've heard Michael Burry talking about it. He's currently short the markets. This guy is pretty accurate in terms of assessments for his trading. His biggest or his most recent trade that's very notable for him was that he's long GME under $4 with millions of shares. But you add Dalio to the question to that equation, who also kind of feels the same way. And these are some big players who have had a history of being on the correct side of the markets more times than not. And these guys are heavily short, and yeah, we're still pushing. So it's hard for me to trying to jump in when I still see stocks knocking back. And then the recovery case for these growth names that we're going to be talking about here, it's still in play. So if these stocks start rallying, it's just hard for the Qs to just reverse over and roll over. It's hard for the S&P 500 to roll over as these stocks are breaking down north.
Yeah, it's interesting. Just some quick notes. Michael Burry, made famous by the movie The Big Short. It's my favorite market movie. I think it's one of the more accurately, in terms of the background and the way it was done and the way they portrayed things, was very accurate, including the guys talking at the bar that really didn't know what they were talking about. I'll leave that particular sector alone. Also, Ray Dalio, founder of Bridgewater, world's largest hedge fund. So, Charlie, in terms of actual trades, you sent me three, and I like two of the three, and I want to go into the one that I don't necessarily like the trade of, and that's AI. Tell me your thesis on AI, and then I'll tell you what I don't like about this trade, and then you can kind of defend it.
Yeah, so I'm not really a big chart pattern type of guy. I'm more into real hardline tech, reaction at price. But when you look at AI, and we've seen where they've come from, which is like, that 150 to 180 range. Now they're trading in that 40s and 50s. Certainly their valuation got way ahead of them. But what's great about them is that they're a high demand momentum name. So when AI gets going, I mean, it really gets going. And so they have a chart pattern called a inverted head and shoulders. Now, most people may know what head and shoulders are, but if they're not, it's basically three tops where the middle one is higher than the previous two and the other two are centered around the same price. The head and shoulders is actually a bearish trading pattern on the chart. Well, the inverted head and shoulders is a bullish pattern. It's kind of the mid peak would be the lowest, and then obviously the shoulders would be around the same center price. So really what gravitated towards me in terms of my attraction for the stock was that they've really been basing here around this $55, $56 price. And then they jumped over the 50-day moving average and held it immediately. So I work in the thesis of what's called close and open above critical price levels. And when we see that close and open, it basically leads to kind of like a short-term trap, whether it's for buyers or sellers. And so them holding the 50 immediately, I think that they could lead to a little pop. I'm not looking for a home run play, but I think that, getting to, 70, $73 by the end of this week, if the market remains somewhat bullish, is not out of the picture. That could be a 1 or 2 day move in the stock. And that's really all I'm looking for. Now, the longer term thesis, I think that it could get above $80 and kind of look to test that, $95, $100 range. And I don't think that could happen by the end of the week unless something crazy happens. You never know. But with the momentum behind the stock, if the bullish case is on, the upward trajectory, it won't take too long to get to, the dedicated price level. That recent swing high would be one of them, right near that 79, where those two large green candles are. So even back towards that price level from where it currently is a great return in a short period. And that's all I'm looking for, a lower risk, higher reward variant. And the momentum case, which is really starting to really pick up steam. If we look at Roku and how they've recovered, and a lot of these cloud tech names, and even the semis are waking up. I just feel that the broad sweeping demand for momentum momentum stocks are coming in. AI is going to be a beneficiary of that demand.
Okay, so then I'm going to take back what I said. You already kind of answered my question and defended what I was going to say. The company itself, I'm not in love with. I mean, I just think there's not enough data. I am a chartist, right? And I think the chart pattern you point out here is accurate. It's definitely there, and it definitely can play out. You've got 2 to 3 targets on this trade, really. You've got short term, you've got medium, and you've got long term. And your long term thesis is kind of what I had a problem with, because if things are repriced, it isn't necessarily that AI specifically is going to go. It's going to be dragged up if momentum names pick up again. That's sort of your thesis.
Yeah, absolutely. I'm certainly not trying to pummel it to the fact that they're going to be the next Roku in terms of momentum, and
Gotcha.
that they're going to have this creative technology at all. I just think the opportunity is there.
Okay, so I no longer disagree with this trade. I'm going to retract that live on the air here, and let's get into Baidu, because Baidu I do like. You like Baidu and you like CHWY. So we're going to put up your Baidu chart, and let's talk about that one.
Yeah, I love Baidu. I think that they get above 204, because for me, it's also the Chinese tech sector is kind of in that boat with semiconductors, where we may have seen one or two make huge runs here as of late. Nvidia for the semis, most notably, but they've kind of been left behind. They're the last of the major momentum names that have yet to really come alive. And certainly last week, that's where Baba and Baidu really woke up. So Baidu has kind of been in this boxy range between like 177 to 204. And that's why I think the escape of 204 should lead to a nice little squeeze play right to 220. I do think that if the momentum is there, 220 is actually in the picture by the end of the week. And the long-term thesis, fundamentally, I think Baidu has incredible value. This is a company that is obviously kind of viewed as the Chinese Google, but it's not just that. They have some, hands-on with cloud. Obviously, Baba's more the cloud play. What's really interesting with Baidu is their push into AI. They've dedicated a lot of money towards AI, and they believe that AI plus EV is going to be a great combination for them and a money-generating, venue. And you hear those two words together, you automatically gravitate towards a company like, Tesla. And so in China, the one company that replicates Tesla is XPeng, XPEV. But truth be told, XPeng can get wiped out or bought out by a company like Baidu, who has a dramatic interest in both AI and EV. So since we talk about the AI thesis, we talk about the EV momentum thesis and the recovery of Chinese tech. And again, it's not like Baidu is some startup. It's not like Baidu doesn't make billions of dollars every quarter. It just seems like the case for risk on is well overdue. So short term, I love the upside opportunity. I believe they could really get back towards that 250, 270 price without too much issue if the bull thesis for the market is on. But in the short term, that breakout above 204, especially if they break 204 and hold that level for immediate support, I won't guarantee it, but I'd be pretty damn surprised if we weren't at 220 here in the very near term.
Yeah, and I mean, obviously, as you mentioned, they make billions. They've got tons of cash. They are pretty aggressive when they target something to buy. And by the way, EVs, big fan of that area myself. EVs and self-driving are my two favorite sort of sectors long term, and Baidu's involved in self-driving as well. So I really like this one. But speaking of tons and tons of money, man, you should see my credit card charges from CHWY. It is insane, dude. I literally I asked my wife, I said, can you take 5 minutes and see if we're getting everything that we're paying for from Chewy? And literally everything was accurate. It's hundreds and hundreds of dollars a month. And we have one dog. So, I
Gosh.
mean, I love this stock. I love this company. We use it a lot. Tell me why you like the trade.
Yeah, I mean, that's kind of exactly what you're saying here. I'm also a high level dedicated client. I have 2 puppies, and it's really cool. Chewy takes a very different approach as a corporation in terms of customer service. And I believe that's where the loyalty standpoint really comes into play. And, Wall Street likes to reward loyalty, right? That's how Apple built their ecosphere. And Lulu is in play with, why Lulu is valued the way they are. And even Peloton is the same kind of case as Chewy. Although I hate that people kind of basket, Peloton and Chewy as the COVID play. These were startups, these are high level, and these are disruptors. And I just really love where Chewy's coming from. Now, we also couple that with Chewy offering prices way cheaper than their competitors, plus they'll deliver it to your door for free. And it's easy to see why that ecosphere loyalty remains strong. And, when my youngest puppy just had his birthday, they actually sent a handwritten note, saying happy birthday. So it's stuff like that, those little things, you don't think of it as much, but it goes a really long way. And Ryan Cohen obviously built a monster. Now he's transitioned into trying to develop a behemoth in GME, but I really love the way that Chewy is structured. I believe the loyalty aspect is going to be the most important. The pricing is going to be, in terms of products, are going to be relevant because obviously it's all about competition. But if they're anywhere in the realm of competition, right now they're actually beating competition in terms of pricing. I just don't see retraction from people that use Chewy. Usually it's like once you use it, you are hooked. And that's the thing. They just got to get people to use it. So I think Chewy is extremely undervalued. If we were going to pick the 3, the one that I would hold the longest would be Chewy. I love Chewy to the upside. Again, I think they've just been beat up because they're too tied to that COVID thesis, and people don't look at the metrics. Their numbers have been incredible. Their growth year over year and year over year after that has been phenomenal. And certainly they'll throttle back, but they're not like DoorDash, where DoorDash flat out said that they were big beneficiaries of COVID, that they don't expect the same growth. Chewy came out and actually said, we're expecting more growth this year. We're just going to ride the waves. The pet industry, obviously, like you said, it's the same thing as like with parents and kids, parents spending a ton of money on kids. It's one of the largest consumer groups out there. Just these little kids, same thing with pets. It's a big money grabbing industry, and Chewy's going to be a big part of it.
Yeah, I think your quote of the show is actually that there's 2 types of benefits from the pandemic, and Chewy is certainly one that I don't think is going to suffer. I'm on the same page as you. I don't think Peloton I could see suffering as economies fully reopen and the pandemic's behind us. But Chewy, I don't think so, man. Nobody is anxious to get back to pet stores.
No.
I mean, they just want their pets taken care of. Charlie, tell people where they can get a hold of you. We've had your social media, your Twitter handle on the screen the whole time, but if anyone wants to get a hold of you, where do they find you?
Yeah, definitely on Twitter at Disciple of Trend. You can find me on Instagram the same way as well. I'm starting to kind of get that going, hang out with the little kids. Definitely at prospertrading.com as well. And yeah, that's about it.
We're going to be right back after a quick message. Coming back with Jim Iuorio. He's the host of Futures Edge, and he's the managing director at TJM Institutional Services. Charlie, thanks again. We'll be right back.
Bobby, you're the man.
24/7 access to diverse global markets. Right here.
That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready.
Well played. I added futures to my trading strategy.
Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it. This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do.
Visit your online broker today to learn more.
We are back with a good friend of mine, known him for 20 some odd years, a wealth of knowledge in futures specifically, but really in all markets. And if you want to follow somebody on Twitter who's fun to follow and who's going to get your back hairs going up, or there's only Italian guys that have back hair. I don't know, maybe Greeks too. I don't know. Jimmy Iuorio, Managing Director, TJM Institutional Services, the host of the Futures Edge with Jim Iuorio. Jim, welcome back again. Let's get right into it. First of all, do you see any effect from in terms of the future side of things from the strikes on the Iranian-backed rebels in Syria, and do you see any effect from the infrastructure plan?
No, well, the infrastructure, take them one at a time. The first one, any sort of acts of war, the old saying is you buy on the sounds of bombs and sell on the sounds of trumpets or whatever that is, meaning war is not bad for stocks, and people understand that. I'm not suggesting that we're going to any war or something, but I am suggesting that the stock market will probably ignore that, which it has. The infrastructure thing, I think, and call it an infrastructure bill, I think is being very generous to it, whatever. A spending bill that perhaps could weaken the dollar bill, that perhaps could drive money into things that are denominated in dollars to get out of your dollars bill. That trade is still going full well. And I think that's one of the things that's fueling the stock markets higher. But I will say this, is that there was a lot of good things we were pricing in for the stock market. The reopening trade, the profligate spending government, the Fed that's willing to ignore what signs of inflation they saw, and they're less willing to ignore it. I understand that. But those things are definitely been priced in. So from a fundamental basis, I have a difficult time arguing for higher stocks. However, from a technical standpoint, I don't have a difficult time at all. When interest rates came down a little bit, the Nasdaq shot through 14,000. They've assumed leadership role again. I think that the technicals look very well. So I think it'd be silly for me to sit here and go, fundamentally, I don't see what we're going to rally on the next leg and miss what could be the next leg because of that.
So I want you to argue with me if you think I'm wrong, okay, which you always frickin' do anyway. In terms of the Fed, the FOMC put out a statement basically saying, yeah, maybe there is inflation. Maybe it's not transitory. Maybe it's going to be higher than we expect. And then you had Fed presidents and Fed governors come out and basically say the same thing, except Jerome Powell. He kind of walked it back a touch in his testimony where he said, I still think this stuff is base effect, so temporary. Where do you fall in that? Because I don't think it's temporary.
I don't think it's temporary either. And I think it's so funny because the great cataclysmic commodity sell-off that happened last week and the week before, and things like lumber and some of the meat, like corn and meat, those things happened. And I think people looked at it like lumber was the poster child for the commodity run and thought, okay, good, so maybe it's over for a while. But at the same time, in the backdrop, oil, one of our favorite commodities, was creeping higher. And just to put it in perspective, oil by itself is more important economically speaking as the whole rest of the commodity complex, the raw commodities. And I could prove that with import numbers and export numbers. But I think what it did is it allowed the Fed a little bit more ground cover to pretend that inflation could be transitory. They can just say, look, yeah, lumber was skyrocketing, and then all of a sudden it got pummeled. See, it was a supply issue. It was the fact that boats were stuck up at the Los Angeles harbor, and now all of a sudden everything's been opened up again and the supply disruptions have been solved. I agree with you. I think inflation is still going to be a problem, and I think it's going to be a problem for a couple of years. And I think it's going to migrate into wage inflation as well, with all these nonsense, what Goldman Sachs calls unusually generous unemployment benefits being paid out to keep people from working.
I'm going to steal something again from Kyla Scanlon, who I'm a big fan of on Twitter. She said there's inflation in things we need and there's disinflation in things we want. So in other words, healthcare, housing, food, energy, things we need, and then things like clothing, tennis shoes, things like that, entertainment. To a certain degree, the things we want, there's deflation in. So I'll throw this back to you because I've never had more anecdotal information or anecdotal evidence about anything in my coming up on 30-year career. It seems like every time before a show, I don't cue him to do this. My brother, who's a restaurant owner, just like you are, Branson, Palatine, Illinois. If you own a restaurant, you're seeing prices go up. My brother's chicken breasts have gone from $45 to $95. I believe that's for a case. I got a text from a friend who's in commercial construction and multifamily construction. He got an unprecedented letter, he's never gotten one, of a double-digit increase in cement prices from his main supplier, in concrete, basically. Why would this not be transitory? Why would this be bad for the economy? In other words, if these are one-time hikes in prices, but they stay at that level, where's the trickle down for that?
That's the funny part is people, when the Fed starts saying transitory, they make it sound like prices go up and prices go down. That's not really the way it works. Prices are sticky down. And people who go out to dinner, which is pretty much all of us, have seen prices skyrocket at restaurants, and necessarily so. In my restaurant, Brant's Palatine, Illinois, or you said it once already, we've had to raise prices, and we were not happy about doing that. Like you said, every one of our input costs has gone higher. Yes. In the futures markets now, we've seen a lot of those prices for things that we buy go down, but it generally takes a long time for it to be reflected in the actual prices our suppliers charge us. And then the next step, when restaurants raise prices, mostly, because of those skyrocketing input costs, they're very reluctant to bring prices down at any point in the future. It's like the gas stations. When you see crude go up 10%, the next day they're jacking the price up at the gas station. You see crude go down 10%. They get a little lazy for the next couple of weeks before they drop those prices. So prices are sticky downwards. That goes totally in the face of the whole transitory nonsense.
But despite that, you're still slightly bullish equity markets, and that isn't necessary. That, by the way, for people who don't know, that's not necessarily a counter. That's not necessarily an irony. Asset inflation is also inflation. So you could theoretically get asset inflation if those customer prices go through. So you want to do a broken call Condor. Before we talk about the actual trade, before we put the slide up that has your trade on it that I made for you, I didn't put Brandt's logo on there though. If you're ever
next time,
next time we'll put it up there. Before we go into your actual trade, which is on the screen right now, tell people what the difference is between, first of all, a call fly and a call Condor, and then a broken call fly and a broken call Condor.
Okay, and these, if you guys have watched me for a while, you know that these are kind of my favorite ways to replicate long positions because of the risk mitigation aspects of it. So let's talk about a standard call fly and a standard call Condor first. So basically think of a call fly this way. It's buying a call spread and selling a call spread to help finance it. Now, the reason my thumbs are together here is because the two middle strikes will be the same. I'll give you an example. And these are similar prices to my call Condor, but I'll tell you in a second. So if you were to buy the 42.90, 43.20 call spread, that's 30 ticks wide, and the top strike is 43.20, and then sell the 43.20, 43.50 call spread, you're long a 30 wide, you're short a 30 wide above it, and the middle strikes are the same. So the most you can make is the 30 ticks here, which is between 42.90 and 43.20. And then you start losing as you go beyond it. And you can lose, all you can lose is what you paid for it because it's equally weighted. Okay, now let's move on to the Condor. Now, this would be 42.90, 43.20. For the Condor, you move this 5 ticks away. So then you sell the 43.25, 43.55 call spread to help finance the one you own. So now there's still 30 ticks wide, but there's 5 ticks in the middle of those two middle strikes. And if it settles anywhere in those 5 ticks, you can make the full 30 ticks of your first call spread. I hope the whole hand thing, Italians talk with their hands, as Bobby knows. So this is the easy way for me to explain. So that's a standard call fly and a standard call Condor. Both of them have their places. The call Condor is a little bit, is a little bit less risky because you can land it anywhere in that 5 ticks and make money, but it's also a little bit more expensive. You get what you pay for. Now, here comes what I like to do, drum roll. And these are non-standard or broken call flies or call Condors. I'll talk about the call fly first. So if you bought the 42.90, 43.20 call spread, 30 ticks wide, and then you sold the 43.20, 43.45 call spread, now they're same in the middle, but this call spread is a little more narrow. This is 30 ticks, this is 25 ticks. So if the market shoots through higher, you still make 30 ticks on the first call spread, sell and lose 25 ticks on the second call spread. So even if it goes way beyond where you intended it to, you still will make those 5 ticks. Now the call Condor, this is to my trade. This is the broken call Condor. If I'm putting anyone to sleep, I'm sorry about this. I'll try to do something a little more crazy to keep you awake.
That's okay. We're going to put your trade. You're going to actually put your trade on the screen for this. So go ahead.
Okay, good. And I have trades like this on all along the expiration because this is kind of the way I'm replicating my long positions. But one I put on today this is week 1, July. This is for Friday, July 2nd. buy the 42.90, 43.20 call spread. So that's the 30 tick wide call spread that I've been talking about this whole time. And then sell, this is a Condor, so we move that middle strike over a little bit. We sell the 42.25, 43.50 call spread. So there's 5 ticks in the middle, and there's only 25 ticks in this call spread. So in the middle, those 5 ticks, I can make the full 30 here. Again, I paid 6 ticks for this. So you risk $300 to make a possible maximum of $1,200, 24 ticks, if it settles between those 5 ticks. I usually don't keep these on to the dead last point of expiration to try to get the most out of it. I think greed kills. You try to get, a double or triple out of one of these trades and then call it a day. But it expires this Friday, and if the market shoots higher, I don't lose all my money because the 30 tick wide is more than the 25 tick wide that I sold. I'm exhausted, Bobby. Was that an okay explanation or no?
Yeah, no, that's good. And we put up your trade for a reason so people can replicate it if they want to. They can watch it during the week. This thing expires on Friday, so it's a faster trade. Do you see Theta getting a little bit busier as we get toward the holiday? In other words, time decay being enhanced even more?
Yes, and that's one of the reasons. One of the reasons I like these call condors too is, and particularly it expires quickly toward the end, so that call spread you're long, that you're short in the end, starts decaying faster if you start to get into the money on the first one, which is what I'm experiencing today in a call condor I have on that expires Wednesday. I'm in the middle of the first call spread. So it's gaining, even if it just sits here, it's gaining a little bit of value because the call spread I'm short keeps disintegrating.
And just
I love Theta when it's in your favor, right?
Yeah, absolutely. Now, last thing before I let you go, because we want to get Mike Arnold up here for the Open. In terms of 300 risk, 1,200 reward, but your full disclosure moment is you don't usually hold these things to expiration. So that's just kind of like the math of the trade.
Yeah, it's a math of trade. And again, if you're someone who holds it to expiration and tries to get the full amount, you've got a stronger backbone than I do because it can get a little dicey at the end there. But what I'd like to do, like the one I have on for Thursday, I bought for 6 or 7 ticks. Right now it's trading about 19 ticks with about 22 intrinsic. So if it goes up to like 22 today, I'd probably cover it. And consider that a nice. Oh, by the way, it's 40. The one I have on for Wednesday is 40 ticks wide on the first. That's why these numbers seem a little higher. So if it gets up to 22, 23 today, I'd cover it. If we get to Wednesday, and I still basically the only option that I'm concerned about or interested in is for me it's the 42.55 and the one I have for Wednesday, and then I'll just maybe cover all the rest of the stuff and let that run and see what happens. But I will probably be all out of it several hours before the close.
Jimmy, where can people reach you? We've had your Twitter handle up on the screen for most of the time you were talking, which was a long time. But where can people get a hold of you? And you've also got a show coming up, so tell people when that is.
Oh, the show is important. So let's talk about that first. And you're going to be a guest on it. It's Wednesday of this week.
I am.
3:30 New York time, 2:30 Chicago time, called The Futures Edge. Please sign up. There'll be a link at PureXposure. It's going to be fun. There's also going to be how do you pronounce his name again, Bobby? He's a new guest, so I've seen him talk, but I can't remember how his name.
Ted Seifried.
Ted Seifried from Zaner Capital, and it's going to be a fun time. Secondly, how to get a hold of me is on Twitter at Jim Iuorio. That's JIMIUORIO.
Jimmy, thanks again for being here. We will be right back. Don't forget Branson Palatine if you're ever in Illinois. We'll be right back with Mike Arnold after this quick break. We'll see you in a minute.
24/7 access to diverse global markets. Right here.
That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready.
Well played.
I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it. This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do.
Visit your online broker today to learn more.
Welcome back, everybody. I am here with Mike Arnold, who is the Chief Technical Strategist, Chief Technical Officer, I should say, of Pat Trading Partners. And he is also sort of the caretaker of the Pat Trading Partners YouTube channel, which I'm a massive, massive fan of. And he's also the co-portfolio manager of the stock think tank. Mikey, I love the shirt again. You are just lighting up the room with that shirt, which is one of my favorite things about you. We've got your Twitter handle on here. But before we get started, I want everyone to know where to go see these videos, because I've been retweeting a few of them, especially the Tesla one. And then you had a crazy classroom that you spelled with a K, which was very clever, got my attention. So tell me where they can find your videos, because those things are so good.
Just go to YouTube, Path Trading Partners, and videos go up pretty much every day, and maybe not Saturdays unless something's happening in the cryptoverse. But there's not just stocks, and people have been putting in a lot of, I'll call them subscriber request stocks, where I will analyze a stock for them. But we also have, as you said, the crazy classrooms. I did trading around the core position, and just we highlighted it with Tesla because so many people are just long-term Tesla bulls. But people wanted to know, well, how do I take advantage if there's a sell signal or this? And I went through, how you analyze different time frames, how you add and subtract to positions. So that's a pretty interesting video, and there's tons of videos up there.
All right, so let's get right into things, because we did some trades in the stock think tank. By the way, when I call Mike the co-portfolio stock think tank, I'm the other portfolio manager of stock think tank. So from a perspective of the trades we did versus trades we like and didn't do, last week we got into a Home Depot trade. So I want to have people take a look at your Home Depot chart, because it's not that far away from where we entered. It's doing what I would call well, at least from the perspective of this chart. While you're looking at this, I'm putting up, we've got it on the screen now, and I'm putting up Home Depot, which is HD as a symbol. And we're actually down about 50 cents right now. So this theoretically is a trade that somebody could still get into.
Yes, pretty much since we entered it last week, it's just basing sideways. So it's actually sort of building this little shelf pattern. And I mean, you have, which one do you have up now? The weekly chart?
We're gonna put up the Home Depot daily. We put up the weekly first. We're gonna put up that Home Depot daily.
Well, the weekly chart was really nice. We have a proprietary little entry based off percent B, a Bollinger Band pattern, and that triggered, it's a very reliable pattern, and it triggered on the weekly last week, and we came out of the weekly rotation zone, and now on the daily, it's just sort of basing sideways. We're waiting for the rotation zone to come in our favor, but I really like this. It bottomed around that 298.40, and then we had a nice 3-day rally, which took it slightly overbought, and now we're burning off that overbought pattern by drifting sideways. So this is definitely a trade that's still actionable, and it's a longer term trade. I mean, what's our total? I'm just glancing over at our portfolio. The total target for this is a 327.95. So it's got some room to the upside to run. So this is not something we're looking to be in for just this week. This could be, one of our average length holds for about a month.
And this is an actual target. This is not like analyst targets. So I always tell people, analysts from some of the big shops like JP Morgan, Goldman, whoever, pick your big shop, Deutsche Bank, Stifel, doesn't really matter. These targets that they put out, they will adjust their target down. If the stock starts to go down, they'll adjust their target up if it starts to build momentum. This is an active investment target. You're expecting it to get there, and then you're going to do something when it gets there.
Right, exactly. And in this case, unless this really started running hard and we could produce a new higher target, we will exit the position at that target and then watch for a potential re-entry. Many of these stocks, they hit our targets. They might even go beyond our targets a bit, but then they pull back. Prime example, we had that double bottom that we traded in gold. It went to the target, went beyond the target, and I got questions, well, why'd you get out? But then it plummeted back down. So now we're, again, watching for a new entry in gold for a long-term play.
So let's put up this HD weekly one more time so you can kind of go over what you liked on the weekly chart there.
Okay, the Home Depot weekly, It's came back. We have the orange and blue lines that came back straight to the bottom of the weekly rotation zone with that red candle closing pretty much just slightly below the rotation zone. But then we start watching for that strong rotation up, which we just got with the closing of last week. So you can see we had a multi-week pullback to the rotation zone, and now we're getting that rotation up, which is the kind of setup we really enjoy, especially since longer term we are bullish even fundamentally on Home Depot, even with these little minor basing sideways or slight pullbacks.
Yeah, definitely. There's a seasonal effect in Home Depot that people kind of neglect. We're used to looking at seasonality in commodities, but in stocks there are reasonable seasonalities that you can actually, your everyday person can understand. And obviously, doing remodeling projects and things in the yard and things like that in the northern states, Home Depot tends to get a little pop from that. So this is usually a seasonally strong period for Home Depot as well. Some people might think that they might suffer from the reopening, but so much was done during the pandemic. Now you can actually do things outside and continue to work outside in what was much colder weather. And now it's turning into pretty hot weather up there, isn't it, Mikey?
It was hot. Now it's just rainy. We got essentially 3 months worth of rain in 3 days. So,
all right, let's take a look at the second one that we did not do, but we both still like this. And we're going to look at the UPS daily. We're going to put up the daily chart of UPS. So what are you seeing here?
Daily chart UPS, we actually triggered a double bottom trade. And these have targets of 210.13, 212.57, and 215.01. We still may be looking to get in this. We couldn't last week because we actually, before we exited another position, we ran out of margin, which means we couldn't, without exceeding our margin requirements, put on another trade. So we had to pick between Home Depot and UPS, and we picked Home Depot, although UPS, it did trigger also a nice weekly pattern, and it triggered that daily double bottom. Again, that's the full target on that is only 215. So that's back where it sort of based sideways before the sell-off.
Now let's take a look at the UPS weekly and tell me what you're seeing on that weekly chart now.
So on that, we have a nice, we use not, excuse me, we don't use Fibonacci, we use a harmonic level. So we pulled back really nice to 37.5% harmonic into the weekly rotation zone, and last week was a rotation back up. Now this was not this, the difference between this one and UPS was this one and Home Depot. Home Depot triggered that %B Bollinger Band buy signal. This one did not, because it did not pull back quite enough, but it did trigger the daily double bottom. So it didn't, I prefer weekly patterns over daily patterns because they tend to be stronger. So that was another thing that went into this play of us having to decide. They both triggered a bullish pattern. The Home Depot triggered a slightly more bullish pattern.
You don't have any fundamental concerns about this. The Home Depot pattern was slightly more bullish, so you picked that one because you sort of had a confluence of factors. But that's not something you normally take into account, right? That'd be the kind of thing you would only take into account if you had a situation where, like we did in the stock think tank portfolio, where we were running a little bit low on margin. Then you would try to pull out some other things to see which trade might be better. Is that correct?
Correct.
So why would you do that? Well, from a perspective of, here, let me just say what I think about this, and you can tell me if I'm right or wrong. Generally, when you're looking at something that has, let's say it has a 70% win probability, is there any predictability to when the 30% of the time that you're going to lose is going to happen?
I wish, but there's not. I mean, then you take a system that won 70%, you turn it into 100% if you knew when the 30% was going to hit. That's also why we do position sizing, because we don't know. We adjust our share size. We've talked about this on past shows. We don't know which one's going to lose. I mean, theoretically, both UPS and Home Depot could come down and hit our stop level, and okay, we're in one, we're not in the other. UPS could go to profit target, Home Depot could stop out. Even though they have decent probabilities, we don't know which one's going to win. Sometimes some of the best setups you're like, oh, this is the best like double bottom setup ever. It's picture perfect, and that one loses. And then, you know, you hate it when I call it a sloppy double bottom, but sometimes, yeah, it was really sloppy. Oh, look, winner. So you don't know.
Well, I do want to point out to people, I'm looking at an S&P daily chart here. And the last show that we had when Mike was on, we talked about I hate to use the word predictability, but the sort of correlation between times when we're not finding trades, and it's generally Mike's process that we rely on for the stock think tank, when we're not finding trades and pullbacks. And that actually then ended up happening about a week and a half after that show. We got a 2 or 3 day pullback in the S&P 500. That then a lot of people reached out to me on Twitter and said, well, are you buying this now? Are you guys buying this? Do you see a correlation now to available trades and what's going on with the new highs? Or again, is it just a function of I find what I find and it is what it is, and the only sort of predictability might come when you're struggling to find trades?
Well, I went through close to 300 charts this week, and not just for stuff that we would trade in our stock think tank value portfolio, but just to see, because this market's marching up. When we also talked about on the last show, we had that double bottom in the NASDAQ. We were watching that hit all the targets, and now we've continued higher. What I'm finding, though, is there seems to be a very strong rotation back into overvalued momentum growth stocks that have already, they're incredibly overvalued, but then broad market, there isn't a lot of strength. It's about maybe 30% of the market carrying stuff higher, and a lot of stuff is either getting weaker and pulling back or just sitting there in a sideways pattern and not doing anything. So the market keeps going higher, but it's doing it on not a lot of broad market strength. It's doing it on very weak, or it's doing it on very consolidated into a few names and not a lot of really. I like to see when things continue to rally, a bunch of the stocks rallying up with them, not just a small handful, and then a lot of stuff just sitting there dormant.
So where can people find you? We've had your Twitter handle up, but mostly it's YouTube where you're active. You use Twitter to kind of help distribute the things. I, by the way, distribute quite a bit of Mike's videos that are on Path Trading Partners. So where can people find you if they need to find you, Mike?
Again, search on YouTube, just go to Path Trading Partners. You can just go to our website, pathtradingpartners.com. You can email me, support@Path Trading Partners, if you have questions. And again, the best thing to do, though, if you want to know what we do and really learn some technical analysis techniques, is go up to that YouTube and also leave some comments, because I do go through the comments and people, it is getting more active.
Mike, thanks for being here again. We're going to take one more break, and I'm going to go to my buddy Jeff Kilburg. Once we get Jeff in here, you're going to know why we love having him on the show. We'll be right back.
24/7 access to diverse global markets. Right here.
That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready.
Well played.
I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it. This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay. I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do.
Visit your online broker today to learn more.
Welcome back, everybody. I'm excited about this segment. I wish I could have got him on earlier, but he has responsibilities as the Chief Investment Officer at CHWY Wealth, and also as the CEO and founder of KKM Financial. I got Jeff Kilburg. Jeff, I've known you a long, long time, and one of the reasons I like having you on the show is just sort of the wealth of knowledge and how you love to make fun of Jimmy when he's not there to say anything. So first of all, I'm going to give you an opportunity to have at Jimmy, and then we got to talk some serious things to talk about here.
You know, I love jabbing Jimmy. It is not as fun for me, Bobby, when he's not here next to me. I remember all the years that we would punch it out on CNBC. It was so much fun to go back and forth. But I'm going to reserve any type of sparring for his restaurant at Brant. See that, Jimmy? That was a plug for you. One of the best burgers and ribs in town here in Chicago. So I'll hold off on that. But so much to talk about, Bob. It's a remarkable. As we close out the second quarter, we look forward to the second half. There's a lot to digest here, all the while where we're just focused on the Fed. But that Fed policy is really setting up the second half for the year, in my perspective.
So let me ask you, we saw basically a reiteration of the Fed statement by several of the Fed governors and voting members that are presidents of the individual cities' federal banks or central banks. What do you think of Jerome Powell in terms of kind of going back on that? It was my view that he walked his comments back. I mean, he has to make a statement representing the FOMC when he makes that statement. But then when it was him individually, he still believes these are base effects. Where do you fall in that?
And I think you're absolutely right. And the only thing I would add on to that, Bob, is that it's interesting. They floated the balloon. They put a little bit of a hawkish jab or punch. I'm back to Iuorio. I think about Iuorio now. But think about that hawkish jab that they threw last week. For the first time, anything hawkish. For the last 14 months, we've seen nothing but dovish. We've seen accommodative stance. Remember March 23rd when Fed Chairman Powell came out and talked about that the market will be supported in perpetuity, in unlimited capacity. Well, that dovish stance has to come to an end at some point. But what's interesting, to your point, he threw it out there. Markets didn't really love it. But once we digest it, we realized that this is no time soon, but they had to really just kind of float that balloon. So Fed Chairman Powell is in control. Let's remember he continues to be redundant and really articulate the message that they are going to let inflation run hotter. And I know Fed Bullard loves the camera, but he doesn't have a vote this year. So it's critical to understand who has a vote, who doesn't. And ultimately, it's not a dictatorship in the Federal Reserve, but it kind of is. Fed Chairman Powell is calling the shots. And I think they're really going to be focused on letting those rates, because with the Fed balance sheet now over $8 trillion for the first time, that's really important, Bob. We went over $8 trillion for the first time in the month of June. They cannot afford borrowing costs to go much higher. If you talk about a substantial move higher in the long end of the curve, you're talking about $300, $400, $500 billion, $500 billion just in juice, just in interest. If we do see those rates go higher, that's why I'm a big believer that we're not going to see rates move at all for the rest of 2021, and they're not going to move higher in 2022. I think this is a 2023 conversation.
So do you think actually part of the thesis is to keep borrowing costs low for the U.S.? It's not just about inflation and jobs?
I think it's a part of the equation.
I mean, they obviously can't say it, right? There's no way they can say that.
That's right. And I think what they realized that, let's go back to 2008, the recession, the Great Recession, when they took their balance sheet and they grew it to the extent they did. Remember, pre-2008, that balance sheet floated from $400 billion to $600 billion. Boom. It moved up to $3.5, $4.5 trillion after recession. They've never been able to unwind that. Here we are in a pandemic, which no one saw coming, but now we're above $8 trillion. So I think this is kind of the new normal, and the Fed's not going to have the ability to unwind and really reduce that balance sheet. This is one of the biggest drivers in the overarching theme. And now when we talk about central bankers over across the pond, we are seeing a lot of competition / cooperation. So this global central bank intervention, or this new mafia that's been created, one of the underpinnings of this moving forward is that these balance sheets are going to continue to be vast and large and robust.
All right, so you're the closest thing we have to two things on this show. Number one, an expert on ETFs. You're the closest thing to anyone we're going to have here as an expert on ETFs. Number two, you're the closest thing to an Ivy Leaguer, having gone to Notre Dame, which is not technically an Ivy League school, but we're all regular guys here. So I'm going to bring you back down to your roots, back down to your middle class, lower middle class roots as a football player and everything else. Where are we? I'm not going to say what inning are we in the bull market. I'm going to say what frame in a bowling alley are we in the bull market here?
I'm going to put this in the 5th or 6th frame. And let's remember, I was lucky to grow up. My dad was an electrician, local 134, a little
Right.
shout out for the local 134 here in Chicago. My mom was a school teacher. But what's important to understand is you're right. That's the approach we need to really take into investing, understanding what's worked, what hasn't. We're all kind of looking forward to this infrastructure spending, whatever that package looks like. But understand the asset classes that actually worked year to date. We look at Brent crude, off the charts, how well it's performed. We look at European equities, outperform the United States equities, but US equities are up there, emerging equities. So you're seeing these different asset classes really respond to not just the federal policy, but the reopening. So I think understanding which sectors are working. And as you know, Bob, I'm a portfolio manager on a sector rotation model. And I'm going to pull it up right here to kind of dive into a little bit. You're not going to be able to see it, but nonetheless, I'm going to pull it up here just so we can kind of speak to it, because this is really critical. And what worked in 2020 is working in 2021. And that's being active, that's being dynamic. It's really understanding that sector rotation. And one of the sectors that we really liked, energy, year to date has been phenomenal. But what's interesting, we use a lot of relative strength. As you know, you're always looking at RSIs on a lot of the futures markets. But understanding relative strength can really help you position an exposure to get exposure to themes that are working, but to stay the heck away from sectors that aren't working. So in 2020, there was no relative strength in energy. It was the worst performing sector in the S&P 500. Things have really flipped, and you saw the US dollar move lower. You're seeing crude oil move higher. And here we are now. So pull up IGE, Igloo, Georgia, Echo. IGE is just a great representation when you see exposure. It's not pure exposure, but nonetheless, we talk about IGE. It really has an ETF exposure where the top 3 names, these are names that we know, Exxon, Chevron, ConocoPhillips, they make up about 25% of the portfolio. But we also see Freeport McMoran in there. We see Schlumberger, we see Phillips 66, and you also get Kinder Morgan. So this is a broad swath ETF that's really performed well year to date. And if you look at it in comparison to XLE, that's the typical broad swath energy ETF that a lot of folks use, it's outperformed year to date by about 10%. So I think it's really critical for all your viewers and traders to understand that there's opportunity inside of a sector. You don't have to just be long this. And this is really complementary. If you have exposure, say you're long crude oil futures and WTI, but maybe you have an offsetting position or a complementary position inside of an ETF. Additionally, if you have IGE or an XLE long, you can utilize crude oil futures to synthetically lock in profits to mitigate risk to the downside, or you can use options on those futures to protect that underlying. So there's just so many tools in the toolbox here where I get excited. I spent a ton of years trading futures, but this is where it gets a little bit more exciting, that you can have the opportunities to put in ETFs in your portfolio and use the futures or option on futures to really trade around that position.
Well, I really think what you do at CHWY and what you do with KKM is, I don't think it's a stretch to call it revolutionary, because you are managing active portfolios of ETFs. And for example, I'm looking at the IGE chart right now, and I can't put it up on the screen, unfortunately, but looking at it, you got a nice pullback right now. And if that's the sector that you believe is going to perform, that's an opportunity, isn't it? I mean, in terms of that sector rotation is not something that happens in a day, like you might get with a GameStop or an AMC.
Absolutely. And look, a lot of the volatility stocks, specifically those meme stocks we've seen, this is a little bit different. That's comparing apples to, probably potatoes, right? So where we get excited about the opportunity and a pullback in here, you can utilize a lot of different instruments. But what's interesting, the overarching theme, and I talk to a lot of smart folks because I don't consider myself that smart, but I love talking to really smart folks. So some of the really smart folks that I know are really deeply involved in trading crude oil futures and all these different energy type of approaches, they're seeing crude oil potentially trade in triple digits. So if crude oil does go above 100, that's really going to put some fuel into some of these specific stocks, specifically an ETF like IGE. Now, I'm not beholden to any specific ETF. We like XLE. There's a lot of different ways to get that broad swath, but I think trading them in conjunction or in lock and step makes a lot of sense. And then when you do look at the relative strength on a specific ETF, maybe it's a little bit overbought. That's the opportunity to use a lot of either the mini futures contracts or the actual crude oil futures itself to mitigate risk, to lock in profits, or synthetically potentially buy into that next move higher. So it just gives you optionality, if that makes sense.
Yeah, it does. And it definitely is. CME's coming out with a micro crude oil future, which is going to be able to get down to sort of, just the detail you can get down to in hedging a portfolio like one that might contain IGE. So on that same sort of theme, What are you starting to shy away from? I don't want to put you on the spot and reveal anything that's proprietary, but what are you starting to either get ready to shy away from, or maybe you've already shied away from it? Do you think people still should?
So we decreased our position this quarter in small caps.
Does the second quarter or for the third quarter?
That was for the second quarter.
Okay.
So for the second quarter, we decreased our exposure to small caps, and we have been rebalancing and increasing our position in large cap blend. So think of a large cap blend. I know the story. We saw the shift in value. Let's go back to last September, right? When we saw the NASDAQ 100, those futures really become beholden to the selling pressure. And you've seen that rebalance. So now as we go into the Q3, we really think it's empirical and important to understand what you own, these tangible names, right? We have infrastructure on the horizon. So I think a lot of these blue chip essential names, we like to call them essential names here at KKM and Sanctuary. And those names are really going to make sense and continue to move higher. So think of some of the cyclicals, think of some of the industrial names. You know, there's names that were kind of unloved. And I know all we do is talk about the FANG stocks on every TV show out there, but there's names, you know, when you look at, you know, in the portfolio, like a GE, like a GM, like a Waste Management, like a 3M. Some of these names, and of course, ExxonMobil, I have to name ExxonMobil. That's the number one position, obviously, year to date. You have to pat yourself on the back when you can, right, Bob?
Absolutely.
But a lot of those essential names make a lot of sense. But I think it's also the sectors. We like owning banks moving forward in the second half. I think the long end of the curve, despite the fact that it's going to be a little stagnant, I think the banks are poised to continue to make money. And it's interesting when you dig down, look at XLF, JP Morgan, Berkshire Hathaway, Bank of America. That makes up 30% of that ETF. So I think you have to understand what your ETF exposure is, what your single stock exposure, and how to utilize futures to really help throttle your portfolio from a beta perspective, right? That risk perspective. That's where futures, and I go back to the 1990s when I started trading futures, futures can really assist you take your portfolio up in beta or take a lot of beta off the table. And that's where I think it gets so fascinating with the CME group coming out, a lot of these micro contracts.
So last question before we have to shut down the show. I like ending the show with you because overall, in terms of, you said we're about the fifth or sixth frame. Do you think people are too late to get into active at this point, or do you think active is actually going to dominate the last 4 or 5 frames of this particular bowling match?
It's a great question. I think the answer is yes. Active still has a lot more room to run, and it's due to the fact that post 2008, you saw about 10 years of just being passive, just kind of snuggling up to the S&P 500. I think it's very different now. I think being active, being dynamic, that's going to be the difference maker. As we're all seeking alpha, Bob, that's going to be the difference. So I think there's a lot more room to run. And remember, the overarching theme here is the Fed policy. And the Fed policy, in my perspective, is not going to do anything until 2023. So we have another 16, 18 months, I believe, in this bull market.
So if you want to confirm with Jeff that I am almost a foot shorter than him, but I am almost 2 shades darker, and that's basically neither one of those things can ever change. They're just never going to change.
I was looking pretty tan. I was on a boat all weekend. I thought I was looking pretty tan, Bob.
No, you shouldn't be on a show with me if you want to look tan. So where can people reach out to you if they want? Obviously, we've had your Twitter handle on the screen the whole time, but if somebody wants to actually talk to you and get involved with some of the things you do at Sanctuary and KKM, how do they find you?
You know, an email, info@kkmfinancial.com. That'll hit me. That'll hit the team. We'd love to try to find a way to be additive.
Jeff, thanks for being here. And thanks you guys again for watching. Thanks to the CME Group and E-Trade for letting us do this show again. And we will catch you in the next show. Don't forget Jim Iuorio's Futures Edge will be this Wednesday, the 30th. Thanks again for watching. We'll see you on the next show.
Access to diverse global markets. Right here.
That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready. Well played. I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it. This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do.
Visit your online broker today to learn more.